Okay, sorry for that mishap. It cut off on me, and we are using technology. So, what do you expect? And like I said, this is raw and unedited. So, I just had to start a new video, and we're just gonna go from there. So, we were getting into vitals, and here we go. Okay, so we were talking about vitals. We were talking about finding our return on equity. So we're talking about how equity is the part that if you were to shut down your business, sell all your assets, pay all your debt, what you would walk away with. And so we need to know the return on equity. So the return on equity is net income over equity, and that's expressed as a percentage. Now, why is that important? Well, let's just say that my equity, after I did that analysis and I saw that my income over my equity, let's just say that it was something like 10%. Now, think about that. What does that mean? That means that the part that I can walk away with right now is earning me 10%. Now, think about my alternatives. 10%. That's a big amount, especially right now in this market. But in some markets, 10%, there were times when long-term yields were over 10%. I mean, so there's environments where 10%, that there are fixed income instruments for 10%. Now, does it make sense to run a business with all the risk that there is, with everything that can happen, the stress, everything? Does it make sense to earn 10% on that equity, or would it make more sense to go get 10% risk free somewhere else? So see, that's why return on equity is important, because it helps you identify your alternatives. It helps you determine whether, if you're getting enough return based upon what you have in the business, because you could just shut down the business, take that equity, and go invest in an alternative. And so return on equity is important. There are some benchmarks out there, 20, 30%, but some advisors out there recommend 50%. Again, it just depends on where you've been, depends on the industry, depends on those things. So I've given some resource already where you can check those data points. Okay. Another thing, labor productivity. So depending on what type of business you are, labor productivity is a big component, and probably the largest component, labor, of your P&L, other than taxes. So if you think about how profit and loss breaks down, you have sales minus cost of goods sold. That's a big item if that's pertinent to you. And then you have labor and taxes. So those are some really big items, right? Taxes consuming about 20 to 37%, and labor 25 to 35, 37% as well. And cost of goods sold depends on the margin, but 25 to 45. Okay. So labor productivity. Now, I call it labor productivity because when we think about labor, we generally think about labor as a cost. We think about it as a percentage of our sales. That is how we think about it, and that's not an inaccurate way to think about it, but there's a better way to think about it, in that our labor, our people, are investments. We have them here, and they produce for us. They do things for the business. They do things for our customers. And so we need to think about them more as a multiplier, not as a percentage. And so labor productivity is taking and expressing labor as a multiple. So what you're trying to get and understand is, for every dollar of labor that I spend, how much sales or how much margin am I generating? So you would have to manipulate this for your business, depending on if margin was relevant or not. But that is the big picture of what you're trying to get to, is basically how much dollars am I generating per labor dollar. That's what we're trying to get to. And let me see if I have a good example here. Wrong thing. Let's see, what do we have? No client name there, so we're good. But it's an 1120S estimate. Wrong pull up ABC pro forma. Okay, we have ABC pro forma. Let's see if we have a labor productivity. All right. Again, so these templates I'm going to offer you, but these are custom, you know, so they just depend on the customer, depend on how you want to see things. So this is not in the forefront, that portion there, but let me maybe express it in a, you know, just to kind of show this so that you can kind of see what we're looking at, what I want to look at. Okay, so we have sales, we have cost of goods sold, non-labor, and then we have our direct labor. This is labor that is contributing to our sales. It's production labor. So let's just say we had, let's use nice numbers, 1 million, and then cost of goods sold, non-labor. Let's just say that was 450,000. We have a margin of 550. I'm going to back into this. Let's say our labor was, let's say it's 200,000 roughly. An extra zero. All right. So I would take the margin, I would divide it by my direct labor, and I would get a labor productivity number. Now, what does this number represent? This represents basically that for every dollar of labor that I am paying, I am generating $2.75 of margin. See, it gives you a way. Now, think about it. That is a more powerful way, my humble opinion, than seeing it as a percentage. I think it communicates what's actually happened, which is that our people produce, and how much they produce can be expressed this way. And so what are we looking here? Well, we're looking for ranges, right? So we can find out what the margin, the labor productivity benchmark is of our industry by, you know, basically backing into, we can back into a labor productivity formula by taking the percentage and expressing that as a multiple. Okay, so this is also, if I take equals 1 divided by, you can also express it as a percentage, you see. So that's all a multiple is. It's just the inverse of a percentage, but this is more powerful to me. And so this is a vital that's important. Is it our labor productivity increasing or decreasing? And this answers the infamous question, which we never speak out loud, which is, am I overhired? Do I have too much labor? Do I have too many people? And I would bet that especially this last year, because last year the narrative was a lot of materials, inflation in materials, and now we have inflation in labor. And I would bet you that this number is declining for many businesses. And so what does that mean? Well, maybe it's a physics idea in that if we're able to get, like, we know how much yield we can get for labor dollar, and we know where that should be. So if that's declining, then maybe it means we're overhired. Maybe it means our people are not producing as much as they should. It can mean a number of things, but it definitely is something that we need to check, right? Because this is all about vitals. It's also taking care of our lifeblood. And labor is consuming a lot of your lifeblood. A lot of your energy / cash is going towards your labor. And so we need to know, where are we at? How do we assess that? And this is, to me, has been one of the best ways to assess labor and where we're at with labor. And do we need more from our labor, or have we gotten fat? Have we let our guard down and now we need to reorient ourselves and and fix this. And so there's a lot of different ways how you can fix this. You can take the approach as, well, I'm just going to get back into the labor productivity where I need to get the yield that I need to get. And that means I need to cut X amount, or it means that you have to talk to your people and say, hey, this is how much more we need to produce based upon where you guys are at. This is how much you need to produce. So that's a very strong formula. And there's you can actually break this down to management productivity. So there's a lot of different things that you can do. That won't be the topic of this lesson, but maybe in another video we'll go more in depth on this issue of labor productivity and then management productivity as well. So let's go on to the second stage, or the second step of stage 2, which is we looked at our vitals. Now what do our vitals look like? So we're looking at our vitals, we're assessing them, and now we start asking lifestyle questions. So you go to the doctor, what does the doctor ask you? Do you smoke? Do you drink? How does exercise look? And these things. So this is like that, in that, what are you prioritizing? What do your vitals say that you're prioritizing or not prioritizing? And so, the first one that I have listed is establishing a tax planning schedule. So I earlier went to paint, and I described one of the biggest sinkholes or pitfalls of business, and that that lifestyle adjusts to available income. And so if you're paying yourself everything that the business can afford to pay yourself, your lifestyle is also going up, and it's very hard to go back to where you've been. And when things start slowing down, your lifestyle is at a certain level, but your business is declining, and that results in terrible things, bankruptcy even. When I was a kid, I went through that, and maybe that's why I'm passionate about these things. I'm very anal about paying bills on time. I hate to miss a payment, even if it's by a day or two, and it's not even a penalty. But I don't like that because of what I went through, and it's a very difficult thing to go through. And I remember going through it as a kid and seeing my family going through it, and it was just not a good thing. So, and that happens because of, one of the ways that happens is because how I described how if you're not paying yourself for what you do, then your lifestyle is expanding because your business is expanding. Well, and if that stops, well, what happens. The music stops. Another way that businesses get them into trouble, and your vitals look a mess, right? So if you had bad vitals, doctor comes back and says your cholesterol's terrible. Well, it's probably because of what you're eating. It's probably because of what you're consuming, what your priorities are in life, and you're not prioritizing the right things. So here's, when it comes to prioritization, this is how you should prioritize. Where to invest your energy. Taxes, debt, capital, and last but not least, you. This is the fun one. When you get these out of order, you get yourself in trouble. And the reason I say taxes is because this is a lot of times what people do all the time. I have a client that make $1 million. What do? They want to go invest that. They're entrepreneurs. They want to keep rolling that money over. Sitting on cash is a cardinal sin to them. They need to roll that over, put that into something that can make money for them. So what do they go do? Or they want to go pay off their debt. So let me talk about those two situations. First situation, client calls me. Hey, Joe, I know I made $1 million, but I bought $1 million in real estate. Didn't finance it. Side issue. Should I finance it or not? Side issue. Okay, great. Here's your tax bill. Joe, I don't understand this. This does not make any sense. I don't have that money. I bought real estate. Okay. But the real estate rules, IRS rules, say you have to depreciate that over 39 years or 27 and a half. Even though you spent all that money, you don't get deducted right away. See, that's why taxes have to be a priority, because there's different rules, and what you think in respect to how much taxes you should pay based upon how much money went out, how much money you have left, is not the same as tax rules. They're completely different. There's some similarities, but they're different. Same thing with debt. Let's say debt. I made $1 million. I got $1 million of debt. I'm just going to pay my debt off. I have no more cash. I should have to pay no more taxes because I don't have any more money. Well, guess what? That debt payoff is not deductible. You went and bought some equipment. You went and bought something with that debt. You deducted it then. You don't get deducted now. So that's why taxes should be your number one priority in your business and how you prioritize it before you do anything. Because after you account for taxes, and there's two ways you have to account for it. One, you have to account for taxes with regards to I'm making a living, I have a lifestyle, I'm getting paid from this business. So therefore you should pay taxes on those unless you're living off debt. You should pay taxes on those at a minimum. And we talked about that earlier. The other part of it is the getting paid for what you own. And we didn't get too much into detail about that. But all that is that as my business is making money, I'm paying myself for what I do, and I'm living off of that. Hopefully I'm building up some reserves. Hopefully I'm building up some excess. Now, what do I do with that? Well, you should do what companies that are traded on the stock, on the open exchange, you should do what they do. What do? They plan. They have a quarterly report. They figure out how we're going to allocate this excess, and then they distribute the rest to shareholders. That is exactly what you should do. And your priorities, what are you doing when you're sitting down and thinking about how do I distribute this excess? You're going through taxes, you're going through debt, and you're going through capital. And then finally, after all that's been settled, then you pay yourself. And that's how you get peace of mind. That's how you get to relax, not have to worry about it because it's been taken care of. That's the formula. I pay myself, I live off that. I don't got to worry about it because I'm paying taxes on that. Then I make extra money. I don't got to worry about that because I'm sitting down with my advisor or my CPA and we're going through this and I have a plan. He told me to send this much in. I can pay this much debt. My business needs this much capital. I'm good. We'll get into the capital part 2, how much that you need your business needs. I mean, these are all things. That's why the way is really, and I'm going to create, as I'm writing this, as I'm making this video, it's not done, but I'm going to create a cheat sheet that also breaks this down, hopefully into 1 to 2 pages and 3 pages on the way. Because I really think that the way, if you follow the way, you're going to feel better. You're going to feel better about business. You're going to feel better about life. You're going to feel better about yourself. I'm tired of seeing business owners dejected. I'm tired of seeing business owners fail. I'm tired of it. And that's what the way is about. We're going to solve that. Okay. So establish a tax planning schedule. That schedule should correlate quarterly because then if you schedule that quarterly, okay, then now it coincides with how a business on the exchange distributes dividends. They generally do it quarterly, and and then that's when you can also distribute your extra dividends, your extra money, your excess. So do that. So I alluded to some of these as well, which is then you need to create a debt amortization schedule. You need to have a schedule of your debt, tracking your debt. You have debt on your books. When is that going to get paid off? Because we want to start tackling that. We want to handle taxes. We want to tackle our debt. But in order to know our debt, it needs to be on the books. And that goes back to stage 1, right? Which is this part right here. These sinkholes. It's a sinkhole. You think you're good. You think you have equity. So that's going to throw off all of your ratios. They're not going to even make any sense if you don't, because without your debt, you're showing more equity than you actually have. So you think you're doing okay, but you're not. That's a sinkhole. You should be, you're giving yourself a pat on the back. I'm good. But no, you should actually be concerned. Your ROE is terrible. So you need to make sure your debt's there. You need to have your schedule. You need to know your interest rate that you're paying. There's a great opportunity these last 2 years to refinance. But if you don't have that together, sorry. And then, so taxes, debt, and then your business needs capital, right? It's like calories. You need a certain amount of calories to live. You need a certain amount of calories to exist. If you don't, you're not going to be in a good situation. And that's what your business is. Your business is lifeblood, right? Lifeblood. But there's so many. You can think about it as oil too. Like your business needs enough oil to keep running. So what is that number? What is that number? Well, I recommend 2 months of operating expenses. That seems to be the magic number. That's what I do, and it seems to have worked. So after you pay your taxes, after you start tackling your debt, you don't got to pay it all off, but start tackling it. Then you think about how much capital you need. Now you can pay yourself. Next question. Okay, let's continue. I take a little break right there. Okay. So moving on from what are you prioritizing? What does your life look like? What do your vitals look like? We've talked about that. How you're planning for taxes, debt, and capital. 3 items that are important. And then after that's been accounted for, pay yourself. And where are your vitals going? So this is the analysis part here, okay? And the first one I have is compare rate of changes in key items. So let's go back to this example that I have here, okay? Let's go ahead and leverage this, okay? So let's say this is month 2022-11, right? Twenty 21-11. All right, so what you see most often is people compare month over month. So they would be comparing 2022, November 2022 to October 2022 and seeing what that looks like. Is that going up? Is that going down? That's what you generally see. The issue with that is most businesses have a seasonal aspect to it. There are some months that are up, there are some months that are down. So what good does it do to compare month over month when that is inherent in your business? A better approach would be to compare the same month that you are looking at from the previous year. And then what are you looking for? Well, let's just go do this by example, okay? So what are we looking for? 950,000. Let's say oops, what happened? Okay. And let's say this is okay. What am I looking for? I want to see rate of change for these items. So if I see sales increasing by 5%, well, just using small town logic, I would expect these other items to to correlate. And when they don't, that is potentially a red flag. So I also have my CVA, my valuations analysis, and part of the body that I've gotten that from, they also do CFE. So I've taken some continuing education around that, and how they go about and find where there's potential areas of fraud is they use a rate of change analysis. So they use this analysis right here. It really highlights areas that you need to focus in on and zone in on, because if sales are increasing 5% and cost of goods sold non-labor is going 35, there's a problem there. And so that helps me where to focus on, helps me understand where am I going, where am I heading, because that's what we all want to know. Was the future like? Charlie Munger says, show me where I'm going to die so I never go there. That's what this is all about. And so that's what the rate of change analysis is. And if you have that, let's see, Pro Financials ABC, we have, so we have quarter over quarter. You can be quarter over quarter, month over month, but you get the point. We just want to see where does this look like? What does velocity look like? Is it increasing? Is it decreasing? And then how do these items, because there should be a relationship between COGS and sales. They're correlating. What do they look like? Are they increasing at a faster rate or a slower rate? And this to me would be, we need to take a look. Create a cash flow forecast. I don't know how businesses survives with that one. I really don't. And maybe everyone has like a paper napkin, but what we do is we take a top-down approach. So we have cash, target cash. This is that core capital portion that I was talking about. Okay. But we take a top-down approach, meaning we forecast cash. We forecast sales. And it changes everything else. Right? As I do that, everything updates. It's just a top-down approach. And then I have these items right here that I can also update if I need to, or I can come in and I can hard code these items here. But that's what we do. Top-down, sales, sales down. Okay. And what do I have in here? So let's just go through that. One, I have cash. That's my lifeblood. I'm going to focus on that. It's a priority. It's on top. What's my target? What do I need? What's my shortfall or excess? And then sales, rate of change. And then here's some of these vitals that I said are important. And I'm looking for trends to determine if this is a new trend forming. Is this something that I need to address, or is this an anomaly? I really don't know how business